investing in Central Texas, which I think is the best market in the country to be investing. So that alleviates some concern, and we're buying in good locations within that. So, if and when the economy slows down, the music stops. You can argue it may not stop here if it stops elsewhere, but it also is going to bounce back because we're in good spots.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, we've got the North Star Real Estate Conference coming April 24th and 25th in Minneapolis, and this conference is going to be for everyone. We're covering the gamut of real estate. If you are just beginning, this conference is for you. If you have 100, 200, 500 units, this conference is for you. If you want to get into commercial real estate, this conference is for you. And the best part about the North Star Real Estate Conference is the networking. The networking is phenomenal. We've got high performers there. We've got amazing speakers and amazing attendees that are going to be adding a ton of value to your business. We can't wait to see you there April 24th and 25th. Check it out. I'll see you there. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, I'm excited to have Andrew Campbell. Andrew, how are you doing today?
I'm doing great, Todd. How are you?
I am fantastic, and thanks for joining me again. Those of you who've been listening for a long time might remember Andrew from episode 46. And if you don't remember that episode, go back and listen to it. That'll kind of give you a background of Andrew and his company and what they're doing. But Andrew, just give a quick little background, and then let's give an update from episode 46. I think we just got done saying at that time you had 466 units, I believe we said. And so where are you at today?
Sure. Well, brief overview, kind of Wildhorn. I'm based in Austin, Texas. We're a Valueadd multifamily group looking for good quality assets and deals in Austin and San Antonio, kind of really focused on the Central Texas market, taking advantage of our local relationships and market knowledge, and just the sort of dumb luck of being from here and growing up in a market that remains incredibly appetizing from an investment standpoint. As far as, I guess, since we last spoke, what was that, maybe 2 years ago? Yeah. I guess we're about 1,800 units, about 8 deals. Continue to haven't deviated much from our kind of thesis about wanting to be in the major metro areas of Central Texas and being in kind of good locations. Continue to stay relatively conservative as far as what we're looking for and kind of our timeline horizons, and obviously been able to grow some and find deals that feel like meet our criteria and get some scale, which has been pretty beneficial as well.
So I know at one time you had talked about going out to Atlanta and maybe some other markets. You guys were, whether it was just wanting to expand faster, or I can't remember the exact reason, maybe expand faster, you're having a tough time finding deals, whatever it was. And now you've refocused. Well, I should say now, that was a long time ago, but you refocused and said, no, we're going to stick to the markets that we know that we're near. Take me through that kind of process. Why did you first decide to go out or look out there? Yeah. And then why did you say, hey, we're just going to stick here?
Yeah, I think the initial impetus was, wanting to offer diversity to investors and feeling like, you and I talk a lot, or I'll talk to other operators that kind of operate out of state. And I'm always kind of just scratching my head. I'm like, man, I don't know that I could do that, but also feel like maybe we should do that. And we wanted to offer some geographic diversity. And so we picked Atlanta, because it fed a lot of the criteria that we had as far as, big market, growth, job population. Went out there 6 or 8 times, kind of did the whole rounds and studied up on the submarkets, met the brokers, chased a bunch of deals, built the team, had a property manager we were going to use. And I think at the end of the day, got close on a few deals, weren't getting anything over the hump, and realized that, look, these deals aren't any better than what we're seeing at home. Yeah. And you've got the sort of headwinds of, you got to get on an airplane, you got to do some of that personal, pain, but more than that, like, you're starting all over with relationships. Yeah. The property management's gonna be different. The title company's gonna be different. Just there's nuances around your underwriting, your insurance costs, your property taxes. That's all learnable. But when we weren't seeing that they weren't better deals, the cap rates weren't better, the return profile wasn't better, kind of said, and we just, weren't being successful getting them. It's like, well, hey, let's spend that time and energy doubling back down, on our home market, which again is, continues to rank up there as like the best place to be investing. And it's like, don't be dumb, and don't try to do things differently. And let's just really be an expert and focus on where we have extremely good relationships, and we know, what's coming out, what's coming up, who's buying which pieces of dirt and developing stuff, and felt like that was our competitive advantage. And so really have focused that back in around Central Texas. So that was kind of the thought process about why we looked out, and then, why have kind of recircled the wagons here and staying local.
So what would you say about that process? Was it worth doing that process? And if it was, like, what were some key takeaways you really took from it?
I think it was worth it. I think anytime you kind of go through an exercise and spend a lot of time and energy, you learn stuff. We certainly spent a lot of energy, just studying the Atlanta market. I mean, before we even picked Atlanta, we kind of canvassed the whole country, looked at, all the big major metros you'd probably expect somebody like us to look at. That was, I think, very beneficial and helpful, and going out there and realizing that just as much as you wanted to try to build those relationships, that's hard. And I think one of the things we've really prided ourselves on is having great relationships. Unless you're there, all the damn time, and, playing golf and going to the happy hours and running into people at, kids' basketball games on Saturday, like those little things that sort of matter and add up. It's obviously very hard to do remotely. And I think by going through that exercise and understanding that, hey, those are deals, the deals aren't better anywhere. It's super competitive everywhere. If we'd have found, cap rates were 100 basis points better, or returns were looked a lot better, it have been a different story, but that wasn't what we found. So I think it kind of re-emboldened us, like, it's not better anywhere else. The grass is not greener. Like, let's stay where we are, where we have all those things I just walked through. I do run into people playing basketball on the weekend. We can go golf. I can pop over and tour a deal whenever I need to.
Yeah. And there's a lot of benefit in that, right there is what you said. I mean, we've got a deal we're looking at out of state right now, and completely off market, just with the seller itself. And it's tough because the seller wants us to come look at the property before he'll really talk anymore. We've been negotiating, and he says, well, look, you got to come look at the property before we're going to come to, okay, well, now we got to go book our plane. We got to figure out what works for the seller, what works for us. And instead of just being able to drive a half an hour, 45 minutes, or even a couple hours, but where we can do it anytime, any day. So.
Well, but to your point about that, like, we've got a deal under contract right now, and it was off market, kind of just what you talked about. We were talking to the owner. This all came about, the second week of December. Being local, was sure you could have gotten this done out of market, could jump on a plane, go tour it, et cetera. But yeah, that's a super busy time of year. You got family stuff. It's crazy, holidays.
Yeah.
Able to run down there, secret shop it, tour it. Hey, we're definitely interested. Let's go put this all together. And we were able to do that, in the course of 48 hours, really kind of do an initial underwrite and visit and everything right. That's just, it's harder to do. It's not impossible. It's harder to do remote.
Yeah. I mean, look, we're going to go down there. It's going to be just a day trip, but I'm gone all day, leave for the airport at 6 a.m., get home at, 10 p.m. and I got to spend $500 on a plane flight, and so and I got to rent the car. And so by the time you're all done, you've got a full day out of it. And so it's definitely difficult. I hear where you're going with that, and definitely appreciate being able to invest at home. So now being at home, and I guess whether you're locally or out of state, let's talk to us about how you guys have been successful in finding these deals, because you've done a lot of deals since we last talked. You went from 466 units to, what'd you say now?
About 1,800.
About 1,800. So you've grown substantially in just a couple of years. You've been able to close on some amazing deals. So how have you been able to build those relationships? You kind of hit on that already, but how have you been able to build those? What can you give our listeners as far as strategies that they can kind of utilize as well?
I mean, so every deal we've bought has been with a broker relationship. I'd say half of them are off market. Looking back on it, half of them have been fully marketed. But it's all been, it was something we pride ourselves on, is just, maintaining those great relationships, checking in, doing golf outings, showing up to tour stuff. I think you certainly have seen momentum as we've been able to close deals. Your phone starts ringing more and you don't have to make the calls as much. Hey, I think this is a deal you guys are going to like. And some of that is just being very, very consistent and crystal clear with, sort of our criteria, so that, hey, this is a deal you guys are really going to like. Or I'd call them and, I'm happy to show it to you, talk about it, but I don't think it's quite, what you guys are looking for. And I trust their opinion now. And, they know we can perform, they know we'll close. And so I think reputation has a piece of that, the track record, and then just having those relationships. I just can't stress it enough. I think, and that's probably the biggest reason, we pulled out of Atlanta, it's just the difficulty. 100% doable, but I kind of use the analogy of like, where I think we've been successful locally is most of the, particularly, my focal point is we get with each sort of brokerage shop, like one or two guys that I really, really want to have deep relationships with. I want everybody in that office to know me, but here's, two guys that I'm, just like I'm friends with, and they look a lot like me. They talk a lot like me. We all went to a Texas university, whether it was UT or A&M or Baylor or whatever. We play golf. We got kids the same age, because I'm targeting guys that are, like that mid-30s, 40-year-old dude, because that's what I am. Even having that, in Atlanta, it was similar strategy, but it was just, they went to Georgia, or they went to Auburn, or there was just it's a little bit different. And I think just having that, like a lifetime of experiences, all the brokers here are mostly from here, kind of grew up in Texas. And I think I don't know if that's a Texan thing, Texans are super proud.
It's everywhere thing.
But it's like, you're from here, you can talk here, you have those sort of shared common experiences, blah, blah, blah. That's been, really helpful. And it helps the phone ring more often, where, we're getting the first look at a deal, or we're getting here's a deal, we're not taking it to anybody else. That's the deal we got now. Like you're the one and only bullet we got to shoot, and we're calling you. That's a great feeling and kind of very validating. But that's taken, that's 4 or 5 years worth of relationship work to get that.
Yeah, a lot of good points there. And I invest out of state, and I try to continue to build relationships with brokers in state to be able to have the opportunities. And I look at every deal around, but it definitely, there is a massive advantage or disadvantage, if you want to call it, of being out of state. You just don't have those relationships. I can't just show up to every event. I'd be gone all the time. I can't just show up to every broker event. I can't just tour a property anytime. A lot of times I'm writing LOIs on properties. And then when I know I am close, then I'll schedule a flight out. And so there's people that always, I think, discount their own state. They say, well, the prices are high here, I've got to go somewhere else. I think you got to take a step back and realize that prices are high pretty much everywhere. And if they're not high, well, then what's the reason for that? There might be a reason that you don't even want to invest there as well. Take a look and deep dive into your own home market before you start exploring everywhere else, and make sure that your own home market is a place that you think, okay, I just don't have inventory here to buy. And that's the case for me, is there's just not inventory to buy. We sold no properties last year that would have really fit my criteria. So sometimes it is a necessary evil, but for you've been successful at it. Let's talk about the deals you've done, because you've done some awesome deals. I think you've had some really good investor kind of relationship, and I guess just you've changed some of your philosophies or some of your, ways that you guys are approaching your investors. So I want to kind of dive into some of that stuff. So first of all, let's talk about the deals, some of the more recent deals you've done and how you've got them across the finish line. And then we'll dive into kind of the investors.
Sure. So I think first off, any business that stays alive evolves a little bit. And so, we certainly evolved our thinking some, and I think we'll talk about that maybe with some of the equity structures and kind of what we're doing to compete there. On the deal size, I don't know that we've changed our underwriting criteria at all. I think, the last several deals we've done, I'd say the last four, two of them are early 2000s deals where they're like, 2002, 2003.
Yep.
Two of them are kind of that 1980s vintage. And certainly in Texas, I think most of the country, there was a big recession, late 80s, early 90s. So there's not a whole lot of product that was built in the 90s.
Yep.
So you kind of have this gap. So you're kind of looking at, late 80s, usually mid early 80s, and then it's kind of picks back up in like 2000. We've bought a couple of those early 2000s deals. I think that's the next crop and wave of value add stuff. Great bones, new, better construction quality, newer. I mean, so you look at it now, it's 20 years old. So certainly in need of some potential TLC, depending who's owned it. There could be some deferred, but even if stylistically, I mean, you walk into something like, that's ready for a facelift.
Yep.
So I think we're starting to look at more of that stuff, and seeing that, again, our kind of core thesis is how do we remove as much risk as possible? Well, there's less risk in a deal like that because it's newer. You don't have an extra 30 years of 20 years of living in it and the systems and the pipes and just everything. So you're not going to have as many potential whammies and gotchas, just from an operations standpoint. So I think that's something we've looked at. And, I think as we've evolved our thinking a little bit on just the types of deals we want to go look for, really probably have swung more towards looking at a newer deal like that and kind of, those B+ kind of conversations, and I've had some interesting conversations with brokers and investors. Like you hear the term value add and then you hear the term core plus, and like, well, what's the line of differentiates in there? Core is kind of your brand new downtown high rise location and build, last 5 years. Core plus is like a step below that, but you're starting to look at like early mid 2000, 2005 product. Is that a value add deal? Is that a core plus? Who the hell cares?
Yeah.
But I think we're starting to look in more of that bucket where I think it's, it's a little bit less risk because there's not going to be as many whammies, a little bit newer product, and, just a little bit more safety, security, because, I think that's what we're looking for. And that's kind of the message we're delivering to investors. I tell people all the time, we're not here to show you the highest marketed returns. Everything's risk adjusted, and my number one goal is not to lose your money. We're investing in Central Texas, which I think is the best market in the country to be investing. So that alleviates some concern, and we're buying in good locations within that. So, if and when the economy slows down, the music stops. You can argue it may not stop here if it stops elsewhere, but it also is going to bounce back because we're in good spots. And I think that's kind of how we've evolved our thinking a little bit and started to look at more deals that fit that criteria versus the beginning. It was sort of like, we need a value add deal. And you might look at a little bit broader set of potential assets.
So as you're looking at these B+, A- properties, I mean, one of the big reasons it sounds like is basically to mitigate a lot of risk. You feel like those products, and I would agree, tend to hold their value, tend to bounce back the quickest. Tenants like those properties.
Mm-hmm.
Is that correct? Any other reasons why you like that B+, A-?
No, and I think the other piece would be location. They're already going to be in the type of location that is good.
Right.
Has potential to get better, but it's a good location today, and I think we harp on that a lot. I'm not buying an area that I hope the city takes a left turn and grows this way. I can point and show you like, look, this is all, look at the retail around her, look what's already happened. It's going to continue, but I know I'm in a good location. And I think you see that with some of the, that nicer product.
So with that, and with these, value add or core plus, are you able to still hit investor expectations? And maybe you've just been able to change investor expectations, or, how are you doing that? Because I would assume when you get less risk in your deal and you get that, you're getting to that core plus, you're just going to but probably have to deal with a little bit lower return. So what are you doing in that aspect?
Yeah. Again, I on an intro call, an investor 99 times out of 100, I'll probably say that exact line. It's like, you're not going to see the highest marketed returns from us. And everything's a risk adjusted basis. So if you're looking at something that's an 18 IRR today, probably got to look at why is that an 18? There's definitely an element of risk.
Yep.
I also think, for the most part, most investors that we've talked with, even some of the institutional guys we keep track with, everybody's expectations have come down. It's not a market that 18s and 20s just falling off trees like they were, 6-8 years ago. And then it became a 14 to 16. And now honestly, it seems like it's sort of a 10 to 12 type market. At least a lot of the stuff we looked at in Austin, and we're looking at deals and say, look, things are transacting. So stuff is still trading hands, and somebody's buying it, somebody's selling it. They've got a different return expectation, different business model. What is it about these deals that are allowing them to trade? What's their core belief about rent growth or what they're going to be able to do to the property? But yeah, we, lower returns, you're going to have lower risk. And that's kind of, that line we're walking. I think we still feel like we're finding deals that provide an incredible return, and certainly on a risk adjusted basis, awesome. Something that we still believe in putting our own money in as well. But, I think we've definitely kind of rallied more towards.
Hey, we've got the North Star Real Estate Conference coming April 24th and 25th in Minneapolis. And this conference is going to be for everyone. We're covering the gamut of real estate. If you are just beginning, this conference is for you. If you have 100, 200, 500 units, this conference is for you. If you want to get into commercial real estate, this conference is for you. And the best part about the North Star Real Estate Conference is the networking. The networking is phenomenal. We've got high performers there. We've got amazing speakers and amazing attendees that are going to be adding a ton of value to your business. We can't wait to see you there, April 24th and 25th. Check it out. I'll see you there.
The other big thing we did, starting a couple of deals ago, is introduce a different equity structure on our deals. So after a lot of conversation with investors, it's kind of what I spend most of my time doing. If I'm not looking at a new deal, I'm talking to investors. There's two different mentalities that we found. You've got a group of investors that want consistency and cash flow and less risk, and they want, mailbox money, passive income. Typical persona of that person, take you back to my marketing days, might be retired or high net worth, made my money. I take the risk off the table. I just need cash flow.
Yep.
You got a whole other group that wants wealth creation, playing for the multiple, playing for the sort of appreciation value of real estate and what the forced appreciation we want to create. Don't care as much about cash flow because I'm not going to access that money today. And so that person might be a little bit younger, might be investing with their self-directed IRA. They can't touch the cash flow anyway. They're trying to build wealth. Totally different mentalities and mindsets, kind of polar opposites.
Yep.
Having one class of equity, you're trying to serve both of those needs, and you're kind of giving a blended mixed return. What we did is we separated out and we created an A class and a B class. The A class gets a 10% or 9% preferred return paid immediately, but there's no upside. You're sitting in right behind the debt. You're getting paid first. So you're going to get a 9 or 10% annualized return, and you're going to get your principal back when we sell it. And if you want cash flow, you get in tax benefits as an equity owner, but that's like kind of challenge you to go find something that is as good a return as that is with as little risk.
So it's essentially, I don't want to use the word guaranteed, but it's a preferred. So they're getting paid first.
Yep.
So they're seeing the temp. If you can't pay it, obviously it's still not guaranteed, but it's probably as close to a guarantee as we can get without actually guaranteeing, right?
Yeah, it's very, very, very likely.
Very likely that they gets paid. So they're getting that 9-10%. but they're getting no equity upside. So if the property sells and you guys make, $30 million in profits, they don't get to share in that.
Correct.
Okay.
Correct. And that, well, then I'll walk you through the second piece. The second piece, you sit behind the A's, you get a 7% preferred return, you get a lower cash flow. So you're kind of going into it knowing that we may or may not, probably won't, at least for the first few years, hit that 7% cash flow. So that's going to accrue. But because the A's aren't participating in the upside, you get a lot more of the upside. So we're able to give a better equity multiple, IRR, however you want to look at it from an exit standpoint to the investor that's looking for that. And so, going into it, I think we've created a structure that fits the attitudinal and sort of risk tolerant benefits of two different camps of people within a single deal. And the response has been phenomenal. And this is our current deal, I guess, our third one when we've done that. And, it allows us, what I like about it, we get to have totally different type of conversations with our investors, a much deeper level, kind of not just why are you interested in real estate, but what are you looking for? And we can kind of start to, put you in a different either bucket.
Yep.
And you kind of get to know them in a better, sort of more intimate way. But it's allowed us to serve their needs better, which is kind of at the end of the day, what we want to do.
Yeah. Yeah. And correct me if I'm wrong, but that would allow, let's say if you were just to do the one structure that you kind of typically see, you'd be able to pay your 7% pref, you'd be able to give them their return at the sale. And let's just say you're making a 15 IRR in that case, but let's call it a 12 IRR more realistically. In that case, in the case that you're doing, you're giving the 10% and you're also giving the equity. The 10% is getting the 10%, 9 or 10%. Yep. But then the B share that's doing the equity, the 7%, and they're splitting on the profits. Instead of that 12 IRR that we otherwise, they're probably at a 14 IRR, maybe even a 15 IRR. They just take on the risk and I shouldn't say no, but limited cash flow. You might not even average 7%. You might be paying back some of that 7 at the sale, right? Because
yeah.
Okay.
Yeah. And that's exactly right. So when we rolled this out with after a lot of thought and a lot of conversation and a little trepidation, kind of the first deal we took it out.
It had to be pretty nerve wracking.
Let's roll the dice here, see how it goes. But it's been phenomenal. The response has been great. Before we rolled it out, we went back and modeled every deal we had done.
Yeah.
With this structure and see what was the difference. And we saw it was about a 250 basis point lift on the IRR to the B. So you're right. You take a 12, you've made it a 14 and a half.
Yeah.
You've a 1.6 multiple is now like a 1.9. And I think those are meaningful moves. And again, if that's what you want, like 1.9, 2 extra money in 5 years is kind of what everybody wants anyway, like that we can still deliver that. And we've also got a subsegment of people that are super happy and content getting their mailbox money every quarter.
Which one is getting more excitement, more traction?
They're both hot. And I think, again, I'll go back to it. It allows you to have these conversations that are just a lot more meaningful. And, it defies logic a little bit, at least in my mind, but kind of one of our biggest single investors, loads up on the B. And you would think that, somebody putting $1 million plus into a deal would put it in the A and kind of give me the conservative, give me my 10%.
Yeah.
He's like, no, I like the risk and I'm risk tolerant. I like the upside.
The upside.
That's a conversation. I know a lot about him now and his mindset and kind of what he's looking for. And you have totally different types of conversations because we now know that.
Yeah. Yeah. Really interesting. And I like that structure a lot because I've had a lot of conversations similar to that with my investors, and I haven't offered a different structure other than my just traditional. But I've had a lot of investors that say, look, I just, something's easy and, safe. That's what I'm looking for. So if you had a 10%, that would be great. That's what I would want to do. So I think it's smart on your part, your company part, by just saying, look, let's figure out what our investors really want. And let's try to offer both. Like
Mhm.
Some investors are here, some investors are there. Let's give them both. And you really put a lot of thought into that. And man, that first deal had to have been just very kind of nerve wracking a little bit to see if it would actually happen the way you thought it would. How much was
It
that raised,
was.
by the way?
That was our biggest raise to date. At the time, and I think we did like 18 million,
Wow.
17 million.
Wow.
So it was,
That's awesome.
we made the commitment we were going to roll this structure out, kind of whatever the next deal looked like. And when it happened to be this deal and the biggest raise, and we almost didn't, but we said, no, look, we need to try it. And I think that was part of the evolution of what we're trying to continue to do and be as Wildhorn, is evolve with the times. And look, if we're gonna plant the flag around Central Texas and be the experts here and provide deals, we got to get creative. And I think that's one of the fun parts about being entrepreneurial, is like we talked about earlier. You see deals are transacting, record volume in Austin and San Antonio. Like, people are buying these deals. Who are they? What are they doing? How can we be competitive on that front? How can we solve an issue and a problem that we have with the investors? And we feel like took a risk, and it's been good. And frankly, I don't think we'll go back. I think we really like this dual structure, and we'll continue to roll that out until we want to try something else, or until we feel like the market's saying, hey, you need to
Change.
shift lanes again.
Yeah. Good point. So what's coming next? What are you seeing as far as, opportunity, wanting to grow, wanting to maybe wait, other segments? Like, where's Wildhorn going right now?
We're trying to be opportunistic. I think we are just, I try not to drink the Kool-Aid too much of like, oh, we're in Austin, everything's sunny and it's everything's going vertical and going great. But you look around, you talk to people from out of town. I had breakfast with an institutional guy from New York this morning, and he's talking about their next fund, and you got Austin, and it's officially on their list of markets for this new fund they've got, along with Seattle, New York, Philadelphia, San Francisco, South Florida. It's like, and Austin, sort of what, doesn't necessarily compute. But within that context, we want to be opportunistic, so certainly spend in all of our time looking for value add multi deals, kind of like we've talked about. That is what we want to see and do. But looking at, we're looking at some opportunity zone stuff in Austin. I think as we've rolled up our sleeves there and dug in, there's some really advantageously located opportunity zones that, frankly, I don't know that they needed to encourage development in those sectors of the city. It was already kind of happening, but do we have the ability to capitalize on that? Yeah. Is there, with local relationships, is there starting to look at value add multi deals that could potentially be redevelopment plays? And do you we're starting to talk to some developer buddies of ours, like, hey, it's not ready yet, but if this is a 5-year or a 7-year horizon on this main corridor, we can go execute our value add play. What do you guys think about the land value, and where is that going? So thinking about along those lines, and really just trying to leverage the relationships we've got in Central Texas to be opportunistic around cool value add real estate.
Yeah, good, cool. What's a favorite book that you can pass on to listeners? I know I asked you this before, but maybe you'll give me a different one. I'm not sure.
Trying to think I think it depends what you're looking for, right? And are you a passive investor? Are you trying to change the way you think about life? The book that started it for me was Millionaire Real Estate Investor, Gary Keller, kind of local Austinite hero. I think reading that and Rich Dad Poor Dad were kind of what started it for me. Frankly, the books that I read the most right now are typically like biographies. I just read. I don't read. I listen. I just listened to Shoe Dog, the Phil Knight memoir.
Phil Knight, yep.
That was awesome. Just so many lessons about entrepreneurial thinking, risk taking, traveling the world and just rucking up to a factory in Japan and saying, I want to represent your shoes in America. Like, it just takes fortitude and just, like, I think the more you read those stories, for me, you just realize, like, success is not an accident. You're not lucky. Like, you're in the right place because you've put yourself in that place. So I loved reading that book, and it just kind of reinforces a lot of the thinking that, we're trying to subscribe to, just as trying to be good entrepreneurs.
What can our listeners do to put themselves in the right place?
You got to take action. Like, you gotta figure out what it is that you want and go after it. I mean, I quit my job to go do this business, but long before we had 1,800 units, I had a portfolio of 75 personal units, and I said, we want to go do the big deals because I believe in the business plan, the efficiencies, and went all in to go do it. And then we've worked really, really hard to build the platform and build the business. So whether you're trying to start your own business, or you're trying to go, meet people to invest with, or whatever, you're trying to get healthy. I mean, like, nothing's an accident. You have to be intentional about whatever it is you're doing. And so if you want to be successful, like, you got to define what that looks like for you, and then start taking steps. It's super easy to listen to podcasts and read books like Phil Knight's, and it's like, man, that's super cool. Like, okay, well, what do you learn from that? How do you go move forward?
How do you actually implement it into your daily business? Yeah. And you quit your job, you started buying these multifamilies, and then you went and sold your portfolio, your smaller portfolio as well, right? Did you sell it all?
Yep. Sold it all. Don't have any of it left.
And so you just said, hey, I'm all in. I'm going to go all in on this multifamily. This is what I believe in. This is what I'm going to do. And it seems like it's working out for you.
It is. And, we got kind of sort of 2 deals in, and I realized that it felt like this thing was going to work. Number one, it also felt like the small stuff was a distraction, and I didn't want to be messing around with that. Knowing, just the responsibility we don't take lightly of, we are the stewards and protectors of people's hard-earned money.
Yeah.
I tried to eliminate all distractions, and, messing around with my own duplexes and fourplexes, and, like, wasn't a good use of my time. And kind of divested all of that and freed up some capital to put in our deals, and just, but more than anything, it was we're focused, we're taking action.
Were you able to 1031 that profit, or did you just take the hit?
We took the hit. I think part of some of the reasons for selling that stuff was the operating capital, that you need to go chase these deals. So we got to show bank liquidity. You got to have pursuit costs, earnest money, like gag worthy amounts of earnest money that you still put up. And, I still pucker up when you wire that money over. So that was a part of it. So we took the hit and just said, hey, this is operating capital for the business. And
Yep. Cool. I mean, that just shows, though, when we were just talking about, you're committed. I mean, you're fully committed. It doesn't happen by accident. It doesn't happen because you just are sitting around and people are calling you with properties. That's not how it happened for you. It's not how it happened for anybody. You've got to be in the right place at the right time, but you got to be taking action the whole time.
Yep. And it takes time. I think the other thing is the lesson that we had kind of late last year. We're sitting here in January. We were talking about this before we started recording. I think we did sort of 1.5 deals last year. We did a big sort of syndicated deal, and we did a 1031 deal with a partner, which I'll count as a half a deal. But we were, frustrated. It's like, man, we're grinding and we're chasing deals and we're underwriting deals and we're putting offers in, and it's just not working. Getting this deal sort of off market at the end of the year, like, totally validated all of the heartburn and heartache and sweat and tears that we put in all last year. And you felt like, God, we're just like one deal. That's the fruit of all of this labor, and I think you continue to see, like, you just got to consistently be out there doing that work. We've got this deal. I got a call yesterday, another off-market deal. Nobody else is getting a look at it, and we're digging in. I was like, I'll let you know by the end of the week. So you're going to have peaks and valleys, but you've got to be out there every single day putting in the work.
Yeah, it's so true. I mean, I did one deal last year and I was just like, man, this is crazy. One deal, that's all I did. And, now I got a couple deals here that look like they're going to be closing, and you just don't know. I mean, you put all that time in, you got to keep on grinding, and eventually it'll come.
Yeah.
So like you said, it's the long game. It's not all about the short game.
Yep.
It's a get rich quick deal. Last question I got for you before we wrap up. What are your 3 pillars of wealth creation? And I did not ask you that question before because that wasn't even part of the deal.
My three pillars, I say plant seeds, is kind of probably I sort of view every deal we do as a pillar, honestly. And kind of take the mentality that we're planting seeds. We're investing in these deals. Our investors are investing in them, and we're going to harvest them over the next several years. More deals, more seeds. Each of those is a pillar of wealth. I mean, that the idea is to, get close to, for the Class B folks, kind of double your money. That's how you go create wealth. If you can do that every 5 years, hell, you do it every 7 years with little to no risk. Like, that's what it's all about.
Yep. Cool. How can our listeners get in touch with you?
I'm pretty easy to find. Wildhorn Capital. The website is www.wildhorncap.com. My email is just andrew@wildhorncap.com. We've got a Facebook page and LinkedIn and all those things, but email or just going to the website. Pretty easy to grab a hold of us.
Awesome. We'll throw that in the show notes, and so everybody can get in touch with you. Andrew, appreciate it. Appreciate your time. Ton of value you're able to add, and congratulations on the success and continued success.
Thank you. Appreciate it. Enjoyed it. And we'll have to do this again in another couple of years.
Yeah, there you go. Have a good rest of the day.
Thanks.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.